Last night after the live stream show, I spent an additional hour trying to find a new Jim Bianco interview. I found one, and there was some really amazing information on it on a YouTube video that he did an interview for TD Ameritrade a few days ago. And unfortunately, this YouTube video at the time, it didn't have many views, but I suspect it may have more of that. I put about 5 minutes of that audio clip at the end of this audio segment I'm going to do so you can match it with the technical analysis I did. I spent over an hour doing that technical analysis on the 10-year US Treasury yield and putting in when the Fed did the rate cuts and some of the other things, the other events that happened with Repo Madness, when the yields on the 10-year got to the lows for 2019. And Jim Bianco, in that audio clip, he said some very interesting things about the amount of leverage in the repo market. And he thinks, and I agree with him on this, I've been talking about this, blow up in the 10-year, where in only less than 10 days, the yield on the 10-year US Treasury, it spiked more than 26% in less than 10 days, which is very, very rare, very unusual. And he thinks that it's connected to the repo market. And I think the Bank of International Settlements, with their report that they just released less than a week ago, I think that the Bank of International Settlements is actually being honest because they don't want to take any blame for what's coming with the repo market or others. And they were talking about how there's at least one hedge fund or more that has borrowed from the repo market and over leveraged on trades, whether it's these FX dollar swaps or, as it looks like with what Jim Bianco and me have been saying. And I was talking about that big yield spike on the 10-year US Treasury. Remember, I talked about this months ago, right after it happened. Within a couple days after it happened, I was shocked how quickly the yield for the 10-year US Treasury went from around 1.45% up to over 1.8%. I had really not seen a move like that in such a short amount of time. Remember, at that time, I said that my educated guess was that a pretty large hedge fund, maybe more than one large hedge fund, had over leveraged on that treasury trade. Maybe they copied Stanley Druckenmiller's zero interest rate policy trade that he publicly disclosed, and they were late to the party, so they used even more leverage. But I think at least one large hedge fund, maybe more, so maybe this is more than one long-term capital management, was caught on the wrong side of the trade when the Fed ended quantitative tightening, which was balance sheet reduction, and started cutting rates. So I think the Fed ending quantitative tightening and then starting to cut rates, the 3 rate cuts that were done in basically about 3 months, I think that may have not only hurt the 10-year US Treasury market because of the leverage, and you'll have to listen to what Jim Bianco said, but also I think it hurt the repo market too. So I think the repo market, there's problems with at least one or two very large banks, maybe more than that, very serious problems. The repo market is not fixed. They've just been throwing money at it. And it's like that irresponsible child, if you're a parent, where the kid tells you that they cleaned up the mess of their dog or cleaned up the mess, and it's not really cleaned up. So the kid, they say that they cleaned up their toys or their clothes. They just threw them somewhere else so the parent can't see the mess. Or if it's the dog and the dog pooped, the kid didn't clean up the poop. The kid just took a bunch of newspapers, a whole bunch of newspapers, and papered over the poop. Just put a bunch of newspapers over the poop or sweep the poop under the rug. And I feel that that's what the Fed is doing here. To wrap things up for this short little audio, I think the chart speaks more than what I'm going to say here. But I think there is a correlation here. I do not think it's a coincidence. I think there's correlation and causation between what happened to the 10-year US Treasury yield from early September in less than 10 days, that big spike in yield of over 26%, and what happened in the repo market. As you can see there on the chart, it happened, the repo became public very shortly after that big spike in the 10-year US Treasury. So comment below this video if you agree. But I want to thank my over 200 Patreon account contributors. Hopefully it'll be 300 soon. And my dozen or so monthly PayPal contributors, people who tip me once in a while with fiat currency or cryptocurrency. And you're allowing me to focus and be a financial detective and be a good analyst and focus on things like this rather than working a job I hate. I can focus on this because this pays my bills, and I could look for topics that other people might not cover. I think there really is a linkage, a very serious linkage between what happened to the 10-year US Treasury yield, what the Fed did with ending quantitative tightening and the rate cuts, and I think it blew up some hedge funds. So I think there are, and I agree with the Bank of International Settlements in their report, and I think the Bank of International Settlements was definitely honest in the report, and definitely honest not only in the recent report about the repo market and the dollar forward swaps, the amount of them, the massive amount of them that Claudio Borio said in that Bloomberg interview a few days ago. But also, I think the Bank of International Settlements has been warning us now since September about the collateralized loan obligation. So I think the Bank of International Settlements is being more honest with us because they do not want to get blamed for what is to come. They want to say that they gave everyone, or at least tried to give everyone, fair warning. Now you're going to listen to this Jim Bianco audio clip, and this clip is just under 5 minutes. I cut it to only the repo part, and it is really good. And synced with the audio is the chart. So I think it will make a lot more sense while Jim Bianco is talking and the guy is interviewing him when you see my chart in the background.
You're all over the repo stuff. We got to talk about it because as Jay Powell was speaking on repo, that's actually when gold really started to take off this afternoon. Let's say we get Brexit certainty. Let's say we get a China situation. Are those going to be good enough developments to where we can forget about this repo stuff, or is that going to be a risk detached from all our other macro conversations? Is the plumbing in as much trouble as some are saying that it is, given how long this has been going on now?
I think it is. I don't think we've solved the plumbing problem. My take of what Jay Powell said in explaining the repo problem is 3 months into it, we still don't know what's caused the problem. We are still trying to figure it out. And that is worrisome. What the Fed has done, as I've liked to say, is they've medicated the market. It's quiet and it's in the corner because they've pumped it full of reserves or drugs. That's okay for a while. That is not a permanent fix. I would like to know what the Fed's permanent fix is going to be, and they don't have one right now, and that can be a problem as we move into 2020. Look, at any point, they could come up with a fix. I think the real fix is, and he opened the door to this a little bit more, the real fix is they overregulated the repo market and they've constricted it.
Okay.
He used to say at the last press conference, we're not going to change regulations.
Right.
Today he said, we'll look at them. Okay. They've opened the door a little bit to that. But if they were to back off on those regulations to allow the banks to let repo money flow, their cash reserves flow to hand out those loans, this is a critical part of the plumbing. Most of your traders might trade on a margin account. How do you pay for your margin account? You deposit treasury bills. You don't deposit cash. Why? Because we have a functioning repo market that you could take treasury securities and turn them into money. So they're just as good as money. If we have a problem with the repo market, your treasury securities are no longer money. That can be very, very troublesome for all of us. It's not a problem now, but we got to get on with a permanent fix, not just saying we're going to get through the end of the year by supplying a lot of repo.
Help me out as a guy who doesn't, or anybody who doesn't understand it as well as you do, because I look at things here that might be totally unrelated correlation or some degree of causation given the role of treasuries and reserves that we're discussing. The chart for the 10-year treasury future year to date, this repo thing blew up 2 days after the September bottom in the 10-year future price after a sell-off that was almost unprecedented in the treasury market, that took us down to that went all the way from, a yield of, where were we, 1.4 something, and then we went all the way up to 1.9 over the course of 2 weeks, and then 2 days later, this dries up. Is there a connection? I know this is much longer, way out.
Right.
Are they totally uncorrelated?
No, they're not. There's a connection. There's a definitely connection.
So then we should be scared as heck about a big bond sell-off.
Well, yes. Let me give you what the connection is. You're a professional bond trader. You just bought $1 billion worth of bonds. How do you pay for it? You don't write a check for $1 billion. You call up a repo desk and say, I got $1 billion of securities. I would like you to take them as collateral, to give me $1 billion loan to pay for my securities. You can buy treasuries in our parlance on 100% leverage. You have for 200 years. That's the way this market works. So September 4th, when yields were falling, there was a tremendous demand to buy treasury securities. Rates were going negative in Europe. So buy. What's the next thing after you're done writing the ticket? Call the repo desk and finance it. And we were seeing more and more and more demand for repo until we finally realized and then we had the quarterly tax payments and some other things, the market broke. We can't handle it. There's too much. People are asking for too much of this. And then when they couldn't get their repo, you saw the market go the other way. So yeah, it can matter to these things as far as the level of rates and maybe even the stock market as well too. For now, let me emphasize again, for now, the Fed has medicated this market. It is allowing it to function. That's fine for the next several months, but it's not a permanent fix. We cannot just say, well, the Fed will permanently supply repo forever. That will give a whole host of problems down the road. It's a private transaction market. You don't want somebody like a central bank taking over that market and running it. It's not a good long-term solution.
Are the people connecting it to the stock market rally, though, being unreasonable?
Yeah, I think to some extent it's a situation. It's like your plumbing, right? When it works, you don't have to think about it. When it's leaking, you think about it. Well, when it's working, it's not causing a stock market rally, but when it breaks, it can cause a stock market problem. I think it's more, in the words, asymmetric. Okay. It's not going to cause you to go up, but it can cause you to go down if you get a problem with it.
All right. Well said, Jim Bianco.